Okay, I had a couple people email me with questions about the sale of the differential asset when there's a separate accumulated depreciation account. And so real quickly, I wanted to go ahead and just run through a quick example and talk about this a little bit. Let's say we've got the following S entry at the beginning of some unknown year. Just pulling numbers out of thin air, common stock 100,000, retained earnings 300,000, property, plant, equipment. Let's say there was initially a $100,000 differential, of which $20,000 has already been amortized, and let's have some goodwill, and let's have goodwill of 120,000. Let's say this is a 80% owned subsidiary. So the investment level is going to be 80% of this net. So 3, 4, 5, 6, 26, $600,000 in net in the top 5 lines. 600,000, 80% to the non-controlling interest. The other 20% to the 80% to the investment level. The other 20% to the non-controlling interest. And let's have a separate, accumulated depreciation entry. Let's say the accumulated depreciation at acquisition was $200,000. Just pulling numbers out of thin air. Now, let's say this asset was sold. Let's say this differential is being amortized at the rate of, let's say, $10,000 per year. And let's say the asset, the differential property, plant, equipment was sold on April 1st. So as you know, when you dispose of a depreciable asset, the first thing you need to do is bring the depreciation up to date. So we'll go ahead and bring our amortization up to date. We need amortization for January, February, and March. So 3/12 of a year at $10,000 per year. So 1/4 of 10,000 is 2,500. And now we have to deal with the sale of the asset. Now, again, this entry here, that's just a wash. We're closing the property, plant, equipment against the accumulated depreciation. Let's look at the differential for a moment. We had a $100,000 initial differential, of which $20,000 had already been written off. So there was $80,000 as of January 1st. Now, under normal circumstances, we'd simply go ahead and amortize that or depreciate that over the remaining life of the asset at $10,000 per year. If the asset's going to be sold instead, we're not going to have the opportunity to write that off gradually. Instead, we're going to go ahead and write it off as an adjustment to the gain or loss on sale. Now again, of this $80,000 differential, which we haven't yet amortized or depreciated or recovered in a sense, of this $80,000 differential, we did go ahead and write off $2,500 of that through our partial year amortization. So there's still $77,500 still unamortized. So how do we go ahead and so again, basically that additional value now needs to be written off as a loss. So we're going to write that off as an adjustment to the gain or loss on sale of the asset. Now, how do we make that happen in terms of debits or credits? Basically, this property, plant, equipment, we debited property, plant, equipment for $100,000, we credited it for $200,000. This property, plant, equipment no longer exists. It doesn't exist on Little's balance sheet because they sold it, and yet we're going ahead and through these entries, we've been putting these amounts on the balance sheet. We have to take them away. So let's just look at them one by one. Property, plant, equipment, $100,000 debit, $200,000 credit. So we created a $100,000 net credit. We have to eliminate that by debiting property, plant, equipment. Likewise with accumulated depreciation. We credited it for 20, we debited it for 200, and then we credited it again for 2,500. So $200,000 debit, minus 20 is 180, plus 2,500, sorry, minus 2,500 is 177.5. It might be helpful to use a T account for that accumulated depreciation. So what did we do? In the S entry, we credited for 20, we debited for 200, we credited for 2,500. All this stuff nets out to 177.5. So through our elimination entries, we've put $177,500 debit to accumulated depreciation on the balance sheet. That shouldn't be there because the asset no longer exists. So we have to take that away with a credit. And what does it take to make this thing balance? Well, lo and behold, we need a $77,500 debit to make this thing balance, and that's the write-off of that remaining unamortized differential. So if little company had reported a loss on sale, this would be added to the loss. So we debit loss on sale. If little company had reported a gain, then we'd be taking away the gains. We'd be debiting gain on sale. But one way or another, basically the remaining unamortized differential, $80,000 beginning of the year, $2,500 recognized, so we had $77,500 still unrecognized or still unamortized. Whatever's left has to be written off as a loss, as a debit on the income statement. Okay, hope that worked out.